Hi everyone, I'm Oscar.
And Gio.
Welcome to the Come Up. Today we're going to give you 3 ways that you can save for retirement. And if you stick around till the end, we're going to give you some bonus content where we address some myths about the stock market.
So let's get to it.
Part of building generational wealth is setting yourself up for retirement so that when you get there, you can have the peace of mind of not having to burden your kids or having to rely on them to take care of you, and perhaps being able to live the lifestyle that you want to live when you retire. If you want to travel, if you want to take up a hobby, whatever it is, you'll have that freedom and that peace of mind. By the way, we have to say that we're not financial advisors, so what you're hearing is for informational and entertainment purposes only.
So the first type of account is going to be a 401k. If your employer has that as one of the benefits, you definitely want to take advantage of that. I want to run a quick scenario just to kind of illustrate the point of why you would want to sign up for a 401k. Pretend you earn $15 an hour, you're single with no children, and you live and work in California. After taxes, without other benefits, your paycheck would be just under $1,000. Now, the 401k is a pre-tax account, so that means that if you take out 5% of your paycheck, you would actually deposit $60 into your 401k account. You may think to yourself, since I deposit $60 into my 401k, my paycheck is going to decrease by $60, but that's not actually the case. Your paycheck would, in this case, decrease approximately $41 instead of the $60. That difference, that $20 will be yours because it's a pre-tax account. Now, this is not counting if there's an employer match on your 401k. If there's an employer match, that number gets even better, because pretend that your employer does a 3% match to your 401k. That means you would be putting away $96 into your 401k, but your paycheck would still only be going down approximately $41. So, in other words, you've just given yourself a raise. You just came up, you know. If you're not that's part of this secret of building wealth, because if you don't take advantage of a benefit like that, of an employer match, you're throwing that money away.
Yeah, it's just money that you're leaving on the table, that if you don't contribute to the 401k, then your employer also won't contribute to it. It's a way of them incentivizing you to save for your retirement.
Yep. The second type of account is an HSA, which stands for Health Savings Account. Some employers offer HSA, and it is definitely worth taking a look at, because what happens is you can sign up for that account and there are 2 benefits to it. Number one, you don't need to be retired to use this benefit. You can use this for all of the medical benefits of yourself and any dependents that you have enrolled in your employer's medical plan. And then on top of that, it also works as a retirement account similar to a 401k, which is it's pre-taxed. And in the same scenario, if you use 5% to put in $60 into your account, your paycheck would still only decrease by $40 because of that tax-deferred option. The only thing this one doesn't have is there's not typically an employer match like the 401k.
That's a great point, yeah. So first, if you can, take advantage of that 401k because you get that employer match, and the HSA is a nice other option to have as a second retirement account. Or if the medical expenditures come up, then you get to save on paying taxes on that money.
Yeah. Once you sign up for an HSA, you get a debit card, typically either Visa or MasterCard, that you can just use like any other debit card when you're paying for a medical expense, whether it be over the phone or at the doctor's office.
And another option too, if it's easier, is you can just pay with your own credit card, but keep the receipts, and then you'll upload the receipts onto the portal and you can get reimbursed that way as well. Mm-hmm. And the third type of account is a traditional IRA. There's another option as well, which is the Roth, but we're not going to discuss that in this video. So if your employer doesn't offer a 401k and an HSA, that's okay. This is the way to go. And the difference with this is that it doesn't come out of your paycheck. You deposit into this account the way that you would into any other checking savings account. And when you file your taxes, that's where you get the tax savings. By the way, this is not an exhaustive list of everything there is to know about these types of accounts. We just want to cover the important stuff. This video is meant for the working class. So if you are an advanced trader, you're doing options trading or something like that, we're not going to get into that.
Yeah, this is not for you. Get out of here.
Okay, so now you have money in your retirement accounts. What's next? Well, now you need to invest it. And so it's bonus time. Now we're going to talk about some of those myths or concerns that people have about investing in the stock market. One of them has to do with, well, I've heard about Joe or Mary that put all this money into the market and they lost all of it or so much, and then because of the pandemic or whatever, or they took a big dip and they just took their money out after that dip. But that's what you don't want to do. You have to take a long-term view, because while stocks may go up and down, from one year to the next, over the long run, businesses tend to go up.
We are not proposing that you invest all of your money in one stock, because that leaves you vulnerable to the ups and downs of that one specific company. So instead of investing in an individual stock, you invest in what's called the index fund. An index fund is a basket of stocks where it could have potentially hundreds of different companies, some small ones, some big ones, and it averages out the performance of all of those different stocks. And on average, the S&P 500, one of the bigger index funds, has averaged out approximately 9% every year for a number of years.
Myth number 2 is, well, is the stock market just like gambling? So here's what I have to say to that. If you are day trading or you're trading based on memes or GameStop or something or another, then yes, it is sort of like gambling in my opinion. But if you are investing in a basket of stocks, like Gio just mentioned, and you do it continuously, say on a monthly basis, then you're going to be buying this group of companies either when their price is going up or if it's coming down slightly. And as we said, it's trending upwards over time. And so now what you're doing is you're taking a calculated risk. And we already stated that historically, the S&P 500 has had pretty good returns. This essentially is allowing you to tap into the power of compounding interest. All it means essentially is that your money is growing, and as it's growing, it's snowballing and growing on itself.
You can picture how the longer the snowball is moving, the larger it's going to be. You know what I mean? And that is why you invest in a retirement account.
So part of the reason why we're doing this is that I can tell you from personal experience that my parents, until a few years ago, did not have a retirement account.
I think that's basically the experience of most of us as minorities in the U.S. So I think a lot of people can agree with us here.
And that's why we're doing this, because we want to share this information so that you can help yourself, help your family, your friends, whoever, help get you to that generational wealth growth.
If you like the content, like and subscribe. If you have found this stuff useful, please let us know down below in the comments. And if you know anyone that can use this information, please go ahead and share it with them.
See you next time.
What about the fan over there? Do you see the fan, how it's spinning?
Yeah.
It's crazy. All right. Oh, you know what? I forgot to turn off the oven at home. You swing.
So, I don't know. What face should we make?
I don't know.
Surprise face. Yeah, there you go. That's so cheesy.
It is.